I think I wouldn't be surprised if the big tech earnings end up being kind of positive and we kind of get a gap fill here. Like I'm still looking to see if we can re-achieve this key level, and then I'll buy, build up my shorts. I might take some pain in the entry of those shorts because there is a possibility we travel all the way to 6,000 before I think we actually find new lows in the year. So this is what I shared earlier today. This is kind of like my mapping for, I think we're actually going to close at pretty catastrophic lows at the end of the year. I did a big write up yesterday on how Ray Dalio's article is literally touched on everything that I've been talking about for like a month and a half, about how, the damage is already done. Even if the tariffs go away tomorrow, like there's no reversing the damage that's been done, especially when it comes to the restructuring of like basically the global world order and how trade operates, and how allies view trade with the US. Like we've disrupted a system that has existed for 60 years. So I think the market tried to price in with this huge dump how significant that was, but I don't think you can price in something that significant in a month. I don't think that's even doable because we haven't even seen all the ripple effects. Not even go read last week's newsletter. There's a bunch of other risk factors. 5-year corporate debt rolling over could cause a lot of what is already accelerating amount of bankruptcies to really start to pick up, especially coming into the second quarter. So that's kind of what I'm looking at for here, is like maybe we'll get this pump basically into June. It could just be a quick pump through May if these earnings are good. Apple, which I think is obnoxiously bearish, says something like they've already made claims that they're going to rebuild all their production in India in 18 months. If that was like something I could bet on the markets wouldn't happen, I would take a large bet that that's not going to happen. It's going to take way longer than that, in my opinion. But that might be enough. Promises like that, hype like that could easily carry the market higher. So that's something that I wouldn't be surprised if VIX meltdown gave a confirmation, but maybe didn't go below 20. Maybe came down to 20 and we got a nice pump and confirmation. But I do expect VIX to stay overall high. If it does melt to like 17 to this support, that's when I actually start saying, okay, I might start buying weekly VIX calls and just letting them burn until they hit. Especially when we get to like this range, that might be the best way to actually short it, because you can buy with weekly VIX like super cheap. So maybe once we get over like 5,700, just start buying those and just looking for the play that prints 1,000%. When you're looking for a potential trade like that, you can literally fail 20 times in a row and still come out ahead overall, right? So just that thinking and bets mindset for when you're looking for opportunities like that, like on a macro framework. But there's a question here. It's not really relevant to the topic of the class, so I'm going to answer it. Jake said, in a crash, would you ever consider adding something like SPY to a long-term portfolio just to keep steady low risk profit? No. I would recommend that to someone, though. Like if someone who didn't really follow the market, like if my brother-in-law came to me and he's like, Josh, you're a stock guy. The market crashed. What do I buy? Even though I know there's like a million better ways to make money, I'm going to tell him just buy the SPY, because I don't want to text him every other day and be like, did you do X? Did you manage such and such? I'm just not going to remember that. So that would be the advice I give. That's not what I'm going to do, though, right? I've beaten this SPY index for longer than I've even been a good trader, with very minimal effort. So I have no reason to ever buy the index. I also wouldn't recommend SPY when the market crashes. So, I think 3 newsletters ago, go read up on that. But like, I guess I'll just cover it again because I really want to drive this home, for everyone, because I just think everyone has short-term bias. But if we map IWM, small caps versus large caps on a monthly time frame, we can see that small caps always win, almost always win. For the last 2 decades, and even longer if I had more data here, it's like for the last 40 years, small caps have outperformed large caps. And then if we go to the daily chart and we look at the short-term different gap here, large caps have greatly outperformed small caps. I think this is a blip and this is a bubble. And so what I'm looking to buy after the crash is actually small caps, not large caps. And I'm looking for this gap to literally get filled. Like literally 2026, 2027, and 2028 might be years where small caps outperform large caps by 30, 40% year over year. So like that might be a time where I buy that. But if you've been following the investment account, what I've actually been loading up at the lows is AVUV, which actually trends more in line with the large caps, and it's actually done a decent job of keeping up. It doesn't have anywhere near the gap of IWM. And that's because this is a semi-active ETF that tracks only profitable small cap companies. Do you think that allocating a 401k more heavily in small caps is a good idea? Yeah. Historically, if you have a longer time frame, we can just do a historical analysis, right? We just did it. Like everyone thinks the small caps have super high risk compared to large cap companies, but that's only if you're hunting for individual names, right? So like take any time frame over every decade time frame, you finish with small caps ahead of large caps. You know, and if you want to pull this data up on a longer time frame, you can do it, right? So, you know, everyone's got recency bias. You know, a lot of people don't realize.
Small caps are also usually where more volatility lies. So if you're on the selling side, small caps are usually much better and cost effective to sell than your spies and your Dows.
Yeah, people really don't like small caps because they develop a bad bias when it comes to like stock picking. Everyone, you know, people lose a ton of money looking for like the next Amazon when they could have just bought Amazon, right? Um, but if you are looking for a, you know, I would say overly diversified, but if you're looking for a diversified position with max exposure and like an index that's going to outperform or that's going to get the best performance, that's probably the way to phrase that. You want to be broadly in small caps, not large caps. You know, especially now. Like I wouldn't add the SPY, but I like AVUV, and I did buy it on the most recent dip, and I'm looking for another entry. I'm actually thinking about even selling some Tesla here soon, but I'll do a YouTube video about it, or I might even talk about it more in detail on Wednesday because I kind of want to break it down more in depthly. But we're kind of running over the time that I wanted for this class. I hope everyone enjoyed it. I recorded the whole thing, so I'm gonna stop that recording now, and I will.